Hello and welcome to first episode of Factor Investing. I am Ritu Poddar, Head Research and Product at Nirmal Bang. Today we have Mr. Pratik Oswal. He is Chief Business Passive Investing at Motilal Oswal, and today we are going to deep dive into factor investing. Basically, what is factor investing in and what is the nuisance of the factor investing. So Pratik, without taking much time, what initially drew you to the factor investing and how do you define its core principles?
Thank you Ritu for having me. Factor investing as a theme is very big globally. So, when I was first exposed to investor portfolios in the US, I used to be a wealth manager there. I saw that almost all investors that I managed, and I saw portfolios of about 800, 900 customers, all ultra HNIs. All their portfolios had some sort of factor funds. So I saw that it's a big category, and I also saw that as a category, it's the second largest category in the world. The first biggest category is your broad-based funds like S&P 500, Nasdaq. The second biggest category are factor funds. Close to $4.5 trillion is currently invested in factor funds globally. And when I came back to India in 2018, 2019, I saw that a category of factor investing doesn't exist. So that's how we started. So we were one of the first AMCs to launch factors across different factors. So we currently have about 12 factor funds, 10 factor funds that we run currently. And the idea is that factor funds offer dual benefits. One benefit is that it adds a simplicity of a index fund ETF, passive fund, which is extremely transparent and rules based, low cost. And the second is, index funds track the index. And the idea is when you invest in an index fund, you're essentially getting returns of a Nifty or a Sensex or whichever index you're buying. In factor funds, what we've seen in history, not only in US but also Indian history, is that you also get the benefits of active funds, which is outperformance over broad-based indices. So all the factor funds that we've launched, momentum, low vol, value, quality, have over the last 10 to 15 years time, have actually outperformed indexes like Nifty 50 and Nifty 500. So actually it's outperformance at low cost, and I think that's why a lot of investors are looking at factor funds today.
So in the different macroeconomics, do you believe the different factors work? And probably if you can take us through the different economics.
So absolutely. So factors act like, what are factors? Factors are essentially strategies that you can invest in, in active fund management, you have certain active fund managers who are quality oriented or growth oriented or value oriented. So these strategies you can actually buy into these strategies through an index fund. You have momentum based factor funds, you have quality based factor funds, low vol based value based factor funds. But what we've seen is that there are just like we have cycles for industries and sectors, we also have cycles for factors. For example, momentum as a factor, which is the most popular factor today, tends to do very well in upward trending markets. Either recovery markets or bull markets. Whereas something like a quality or a low volatility factor does very well in a bear market. Because as you know, in bear markets, people tend to flock towards quality stocks because they tend to be a lot more non-cyclical. They tend to have very stable P&Ls, not unfazed by economic recessions or expansions. So quality low vol tends to do well, and we have value factor, which does well in a recovery cycle. So whenever there's a recovery in the economy, value stocks tend to do very well. So this is how factors work. We wouldn't, ask investors to time factors. But it's important to understand this because, if you are bought into a factor, and the idea is most investors should take a 5 to 7 year call on factors. And if your factor fund is underperforming, you know exactly why that's happening. So holding on to factor funds become a lot easier because you know exactly its weaknesses, why it's underperforming and how just holding on to it will lead to, hopefully outperformance over the long term. So I think this is a cyclical nature of factors. Just like any actively managed fund, there are periods of outperformance and underperformance. So investors should not have expectation that this will continuously outperform the market at all times.
So as you said, do you think if any factor is underperforming, probably that is the right time to invest in that factor?
Yeah, so not really. So, it really depends. First, if you ask yourself what underperformance are you looking at? Are you looking at 1 month, 1 year, 2 years? So, for example, value as a factor. Value as a factor is a bit tricky because value does well in spurts. So, it does well in economic recoveries. So, value as a factor has done extremely well in the last 4 years. It's done well between 2013 and 16. It's done well between 2009 and 11. So, whenever there's an economic recovery, value does well. However, it's very hard to really time it, because we believe that it's very hard to say what happens in the economy from a future point of view. From like standing here today, I know I am positive that it's going to be a nice bull market over the next 3-4 years, but I really don't know, whether we will have 3 or 4 or 5 months of downward trending markets or upward trending markets. I know over 5 years we'll do well, but in between anything can happen. So I think just like that, we would recommend investors take an exposure of one factor that they like and hold on to it for a long time, or they can get exposure to 1 or 2 factors or 3 factors, which will sort of make their portfolio more balanced.
Do you believe behavioral finance plays the effective role in a factor investing?
I think behavioral finance makes sense in it's a very good question. So in investing in general, I think behavioral is finance or behavioral psychology is very important. We believe that even in factor investing, why does momentum work from a behavioral finance point of view? And I can talk about other factors also. It's because people tend to have certain flaws, or people tend to have greed, people tend to have fear, and factor investing is a type of investing where you want to take advantage of the greed and fear that people have in the markets. For example, value as a factor, people tend to, when there's a market crash, or when there's a bear market, or when there's absolute, people tend to value stocks become very deep value in a bottom of the cycle, and that's the best time to buy it. A value fund will be optimized to buy it at that point in time. Whereas a momentum fund, what we've seen is that people or investors tend to be very late to the party. For example, PSU stocks, defense stocks have been rallying for 3-4 years now, but people are realizing only today. So people tend to underestimate short-term movements, and people tend to overestimate long-term movements. When there's a long-term trend, that's when people come into it. Whereas when you come to a momentum fund, it tends to catch on to trends early. So I think that's the behavioral finance psychology part that factor investing tries to exploit, and which is why we've seen crazy outperformance in these funds.
So any major pros and cons, because every investing has some kind of a positives and negatives. So any kind of a pitfalls you see in this factor investing?
So the pitfalls are, as I said, I think people need to have a long-term view on factors. People need to have a 5 to 7 year perspective on factors. People need to be okay with underperformance in factors. I think there will be periods where there will be underperformance, but it's important to understand that over the long run, say 5 to 7 years, most factors tend to do very well in terms of price performance. So I think that's the thing. I think people should not also take past performance very seriously. What we've seen in historical, in the US at least, is that people tend to come into the factor exactly when that cycle of the factors peaked out. So I think performance needs to be looked at from a slightly deeper lens, because what we've seen is even factors have cycles. And lastly, obviously you have to also look at for index funds, at least you have to look at tracking errors and all of that. So I think look at AMCs that are good at managing passive funds, who have a track record. I think the problem with factor investing today is that there's so many choices. You used to have only momentum, now you have mid-cap momentum, small-cap momentum. You have multiple factors, small-cap, quality, momentum. So I think and the problem with going so niche, small-cap, quality, momentum, is that their underperformance will be much deeper the more complex it is. So something like a very simple large cap momentum, a simple large cap quality is a lot better than having these complex products in your portfolio. So I think people need to be aware that there are lots of products that are coming, and I think people need to, really that choice is something which people need to be very about.
So people often confuse with the quantitative strategy and the factor, and the another one is a smart beta. So if you can highlight
smart
the
beta is the same, I would say, and factors are pretty much the same. I think it's interchangeable. People use factor funds, people use smart beta, so both are exactly the same. It's not much difference. The difference between quant and factor funds is that so basically passive funds are rules based funds. So technically every passive fund is a quant fund, because the rules are specific why a stock should come in the index versus why a stock should not be in the index. Those rules are fixed. The difference between quant funds and factor funds or smart beta funds is that in factor funds, your rules are transparent. So you know exactly what the rule is that determines what stock comes in. For example, for momentum, they use 6 to 12 month price momentum, and they use that to select 30 or 50 stocks in your fund. In a quant fund, the selection criteria is intellectual property of the asset manager. So it is also rules based, but you just don't know what it is. So as an investor in a quant fund, you have to deal with the uncertainty behind why a certain stock is there in an index. Having said that, quant funds are also rules based. So the rules are obviously proprietary. But if a customer wants to ask today that why did this stock come in your quant fund, the quant fund will be able to give very exact analysis as to why that stock came in or why the stock left. So for example, if I run a quant fund today and you ask me in 2019, I sold this stock and bought this stock, why? I'll be able to go back in time and tell you exactly what the reason is, what is the methodology. So in that sense, quant funds are obviously, the rules are not fixed, but you still know why things are happening. Whereas in factor funds, the rules are transparent.
So any kind of a tweaking in this kind of selection in terms of factor, do you see any kind of a tweaking? Like factor mein whatever is the quant based model.
Yeah.
So over a period of time, because market evolves and all, so any kind of a changes happen?
So the thing is, the good thing is that the methodology is something which is today pretty consistent globally, and you want that. You don't want a momentum fund which is different from, like, when you're buying momentum, you want it to be similar to other momentum funds. You don't want two momentum funds which completely no overlap. So then that's even more confusing. So I would say that if you look at the US or other parts of the world, factor funds have become very standardized, in terms of methodology. Just like index funds, a Nifty 50 methodology is very similar to our S&P 500 in the US. Not the same, but similar. So I think the standardization helps investors, and it's much easier for selection.
Okay, so now I would like to change the gear and I'll go in a rapid fire round. So what is the primary goal of factor investing? Is short-term gains or risk-adjusted returns?
I think risk-adjusted returns, never short-term gains.
Okay, and what's the more important in factor investing? Selection of a factor or the timing?
Neither, I would say.
So what would be your answer?
Just, I would say all factors are good, depends on your risk profile, upon what you are comfortable, and obviously, timing, I feel like is a negative thing. You should just be invested.
Okay. So any kind of two common myths which, investors generally think about the factor investing?
Yeah, so I think people expect factor funds to outperform every month, every year, every quarter. That's not true. There are periods of underperformance and outperformance. The second myth is that people tend to time factors,
Okay, so two common risk which is involved in each and every factor, we probably can find it.
Common risk is, some factors have a lot more churn than normal mutual funds. So, expect a fast moving portfolio, and factor funds have slightly more volatility.
Okay, so can investors trust on the backtesting data which is provided by various factor indexes?
Yes, absolutely, because it's backtested, but it's basically it's real data. So yeah, they can I would say trust backtested data, but you have to really see it from a rolling lens, rolling returns, and also how it works in different cycles. So I would say don't do point to point. Look at rolling, look at point to point, look at how it does across cycles. These three is combined. You should look at factor investing.
Okay, so thank you, Pratik. Thank you for giving us insights on the factor investing.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.